clearly. And then after discussing the formats, we will enter into the preparation of financial statements. Fine. Okay, this is what. So what is that we are going to learn? Preparation of financial statements of companies, statement of profit or loss and other comprehensive income. See, you have a good idea about SOPL, but what is OCI? That also you should be knowing. Other comprehensive income section has all the types of incomes which are non-realizable, which are of non-realizable nature. Okay, so all the incomes which are of non-realizable nature come under other comprehensive income section. Now, what do you mean by non-realizable nature income? See, you bought a property for $100,000, right? This $100,000 property, if you are selling for $120,000, you are making a gain of $20,000. This $20,000 can be termed as gain from sale of asset. Gain from sale of asset is a realizable nature income. Why? Because when you sell the asset of $100,000 for $120,000, the $20,000 gain what you're getting in your hands. Something which you get there and then, or you receive there and then, it is nothing but income, and incomes always should be shown in SOPL, statement of profit or loss. Fine. Point number two. This is what is the gain on sale of asset. Let's say you don't want to sell your asset. You just want to hold it for a longer period of time. So you bought an asset for $100,000. We know that assets depreciate. We know that assets depreciate. But here in the first year itself, at the end of the first year itself, you're selling it for 120. Okay. Because let's say you bought an asset for $110,000. Depreciation is 10,000 for this asset. The value what you're showing in the books is $100,000. $100,000 worth of asset you are selling for $120,000. You're getting a gain of 20,000. You are showing in SOPL. But let's say if you don't want to sell it, you want to hold it. Asset is now $120,000. You want to just hold it. Now my question to you is, if you want to hold it, you don't want to sell it, you are you are still gaining from this asset, from the increase in the value of this asset. The gain what you are making from the increase in the value of this asset is called revaluation gain. In simple terms. So revaluation gain is nothing but you are gaining by holding this asset. You don't have the intention to sell this asset. You just want to hold it for a longer period of time. And from that you are gaining. And you're gaining how much? $20,000. Okay, so this is called revaluation gain or revaluation surplus. And such kind of incomes, since you have not sold it, you have not realized anything in your hands. Okay, you have not realized anything in your hands, but still there is an increment in the value of the asset, and that's a gain. Shareholders definitely would like to know whether the value of their asset is increasing or not, as the revaluation has been done by a expert revaluer. Okay, expert valuer. So they have said that the asset value is increasing by $20,000. Henceforth, this has to be accounted, and shareholders will be very happy to know that the assets what they hold is giving them some kind of gains. Fine, by increasing the value. So that kind of income or gain will go in the OCI section, other comprehensive income section, as revaluation surplus or revaluation gain as $20,000. Okay, then SOPL and OCI. SOPL and OCI, the total of statement of profit or loss and OCI would be, let's say there is some $1 lakh. Let's say $50,000 is your statement of profit or loss, net profit. That means you have made a statement of profit or loss and the net profit you got is $50,000. 50,000 and 20,000 makes it 70,000. So this is your total statement of profit or loss and other comprehensive income section total. Fine. Umaya, did you follow this? Hello.
Yes, sir.
Yeah. But now the next question is, how will you prepare SOPL? Okay, what is this SOPL all about? So just I wanted to explain you this because you have come across a new term, that is what is other comprehensive income. Because as you have done your graduation, you know what is SOPL, but you don't have an idea of OCI. So OCI is clear. So what you make in statement of profit or loss, you take all the incomes and expenses and you try to find out the profit from that. Okay, and then statement of financial position is all about assets and liabilities. Okay, and you try to find out the total of assets and liabilities at the end of the year, what it is going to be. So that is nothing but the statement of financial position, which tells you about the financial position at the end of the year of the company, like what it is. And every year if your statement of financial position is showing increasing figures, that means the value of the company is growing every year. Okay, then comes statement of changes in equity. This we will discuss. Notes to finance, notes to accounts is nothing but additional information about all the elements of financial statements. Like let's say you have bought, let's say you have bought an asset, property. Let's say it's a building, land and building. So you have bought a land and building, and you have bought it for $100,000. You can show this on the face of the statement. When you make a statement, you can show that on the face of the statement. You will also depreciate this $100,000 worth of land and building. Every year you will depreciate this. I'm not denying that fact as well. Every year you will be making a accumulated depreciation account. You will be preparing or making a accumulated depreciation account. Just a second, Omaya. Just give me a second. Just give me a second. 2 minutes. Yeah, just a second. So there is like accumulated depreciation account in which every year. So what is this accumulated depreciation? You should understand. First, in normal Indian context, that means when a student in the BCom or in the intermediate, what they used to do, we used to take, this is balance sheet, right? Balance sheet. We used to take what? We used to take building. We used to show 1 lakh. We used to depreciate this building at the rate of 10% on straight line basis. 10,000 first year is gone. 90,000 is the first year ending amount. Then again next year building value is 90,000. Again 10%, 10,000, 80,000. This was the way you used to show every year. That means every year you used to deduct 10,000. This was for the first year. This was for the second year. That means next year when you used to make a fresh balance sheet. That means, okay, I've shown this. Okay, just let me strike this off. This is for 2023, let's say. Then balance sheet 2024. Now the building is 90,000, and at the rate of 10%, if you remove 10,000, the building is now 80,000. All right. So now again in 2025, again you'll take 80,000, you'll deduct 10,000, you'll show 70. It was in that way it used to go. Now, in case of accumulated depreciation account, they will make a separate account called accumulated depreciation. and every year they'll transfer the depreciation account into this particular depreciation amount into this particular account called accumulated depreciation account, and then that depreciation amount will be accumulated in this account, and then the lump sum amount will be deducted from the asset value. How it goes? It goes in this way. 2023, you are making SOFP, statement of financial position, or balance sheet is one and the same. Land and buildings, in that only building element is getting depreciated. Land is not a depreciable asset. I should be clear with you. It's $100,000 less accumulated depreciation. No, first year the depreciation which got accumulated is only 10,000. Okay, it got accumulated is only 10,000. 90,000 is the value of the asset. In 2024 SOFP, there we go, land and building, we will take 100,000 only, not 90,000. Unlike the Indian context, we took 90 and we started, we got 80, and again next year again we'll take 80 and we'll get 70. But it's not like that here. It's always you'll be taking the, you'll be showing the cost, but the accumulated depreciation account will be having 20,000 now. So it will be 80. Okay. In the next year, it will be SOFP for 2025. Land and building, $100,000 less accumulated depreciation, 30,000. 70, like that it goes. Okay. And here again it will be building, you'll be taking 80 and you'll be deducting depreciation at the rate of 10%. 10,000 you'll be getting 90,000. So it goes in the sorry, you'll be deducting, sorry, it will be 70. It goes in this way. So the results are same. Here the asset value is 70, and here also at the end of the third year the asset value is 70. But they, here every time you are showing the actual cost and you are maintaining an account called accumulated depreciation account, which is a contra asset account. Contra asset account means it will be reducing the value of the asset, like provision for bad debts, it's a contra asset account. In case of receivables, it will reduce the value of the receivables or debtors. In the same way, accumulated depreciation account is also a contra asset account. It reduces the value of the asset, okay, every year. Now, so this is clear, some basics we will study about this. Will notes to accounts is nothing but what is notes to account we were discussing. See, after preparing, so how what is prepared? SOPL is prepared, SOFP is prepared. After preparation of all this, there will be footnotes. Footnotes is nothing but at the bottom of the financial statement, you will be having footnotes column. Okay, in that footnotes column, you'll be writing or you'll be giving all the details which you cannot show on the face of the statements. You'll be showing in the footnotes column. What you cannot show on the face of the statement, you'll be showing in the footnotes column. What do you mean by this? What you cannot show in this on the face of the statement, you'll be showing in the footnotes column. For example, we started with land and buildings, right? So we wrote the value. We have just written the value of land and buildings. We just depreciate land and buildings with some particular X amount. Okay, that is 10,000. Okay, we maintained accumulated depreciation account, right? So now in footnotes, what are you going to write? From whom you bought this asset? When did you bring this? When did you purchase this asset? What the original cost of the asset is 1 lakh, that will be mentioning. What you are depreciating it at the rate of 10%. This is your estimation, that will be mentioning. You will be depreciating this asset by what method? Whether it will be a straight line method or it will be a diminishing balance method. That extra information you will be writing. Are you going to dispose of some asset in between the year? That you will be mentioning. Are you going to dispose of any part of this asset in the mid of the year? That you will be mentioning. Are you going to do some improvements or any kind of improvement is done to this asset which you're holding? Improvements are nothing but some kind of extra like amount are you adding to it for any kind of renovation, etc.? Are you kind of buying some additional asset, okay, and that asset you are going to include with this asset, okay? So any extra additional asset you are buying, any asset you are selling, what rate you are going to depreciate it, what method you are going to depreciate it, all the history related to that particular asset and extra information which you cannot show on the face of the statement, you're going to show in the footnotes. Very simple. For that matter and that reason, the footnotes are prepared. And then we are going to study about this particular topic, IFRS 15, revenue from contract with customers. I'll be explaining you that what it is. However, the chapter is a big one. We'll take 2 classes to wind up this one. So let's now enter into the chapter and understand. So first comes International Accounting Standard 1. So what is the International Accounting Standard 1 doing here? First and foremost thing is IAS 1 deals with presentation of financial statements. This particular standard gives you the format how about the presentation of financial statements. That means you are going to make financial statements, of course. How are you going to present each and everything? Each and every element in that financial statement is what this particular standard is going to give you the guidance of. So what is that the financial statement all about? The financial statements of a company as per International Accounting Standard 1 comprises of all these 5 things. First, first is SOFP. Of course, you're going to prepare SOFP, SOPL and OCI. You're going to prepare SOCE, statement of changes in equity. You're going to prepare SOCF, statement of cash flows. You're going to prepare, and footnotes or notes to financial statements. So I'll write it again. SOP you're going to prepare, SOPL and OCI you're going to prepare, SOCE you're going to prepare, SOCF you're going to prepare, and footnote notes to financial statements. Okay, as per Accounting Standard 1. Now, this is the pro forma of financial statements. Already we have done the sole traders statements, right? So this is also very much something which is very much resembling that, very near to very much similar to the sole traders financial statements. And then here we have SOPL, statement of profit or loss for the year ended 31st March 2007. So they have given the pro forma or format of statement of profit or loss. We start with revenue. Revenue is nothing but sales, and then we deduct cost of sales. Okay, so I have already explained you about the cost of sales in our introductory session. Umayya, tell me yes or no. Hello.
Hello.
Umayya, do you remember we have discussed about cost of sales in our previous introductory classes?
Mm,
What is the
yes.
formula for cost of sales?
Total direct expenses
No,
plus
just formula. Do you remember the formula?
uh, wait, sir. I might wrote it somewhere.
I told now opening stock plus purchases minus closing stock. So for that reason, Umayya, I'm going to take 3 chapters, first 3 chapters tests on Monday. You
Okay.
have 1 to 3 chapters tests on Monday. Okay. From
One, two,
FA.
three total.
1 to 3, first, second, third.
Sir, one and two, please. I
Okay,
can
no
cover
problem.
one chapter. One.
We have to finish, Umayya, because our main target is skill level. Here we have to be very firm and serious and very clear. So what I'm doing is I'm trying to give you, as you're free for the entire day, you should be starting to absorb this. Okay. Okay, no problem. For the timing, I'm giving you first and second chapters. I'll share this detail with madam. So be prepared for these 2 chapters test on Monday. Okay.
Okay, sir.
Yeah. And MA test, have you sent? I'll just check.
Yeah, please check.
Yeah, yeah.
Check your WhatsApp, sir.
Yeah. No, just I'll check it and afterwards I'll correct, but didn't see that. Oh, you send like this. Fine. Okay. Okay. Okay.
Um, what format you were expecting? Please let me know, sir.
No, no, no. I thought you'll be sending on paper. Fine. This is very good. Excellent. This is correct, right? I'll be just correcting and giving the marks also to you there and then today.
Yes, sir.
Okay. Give me a second. I'll just have some water and come, and I'll explain this concept once again to you. Need not worry. Okay.
Okay, sir.
2 minutes.
Yes, sir.
Yeah. So Umayya, now I'm going to again just give you the concept regarding this. Please follow. See what is happening. What is happening in this cost of sales, opening stock plus purchases minus closing stock. See, if you bring 100 boxes, all right, for and the cost what you are incurring for this is at the rate of 10 rupees. Fine, that's going to be 1000 rupees, right? You are selling this at the rate of 12 rupees. You're going to get 200 rupees. So your revenue is how much? 1200. What is your cost? 1000. 200 rupees is your gross profit. That's clear, right? So in this context, my cost of sales is $1000. Now coming to, if I change the things, let's say 100 boxes, I bought 80 boxes, I sold, okay, and 20 boxes are unsold or closing stock. Fine. How it goes. So now you will be finding the profit for 80 boxes. Is it right or wrong? Hello? Because you sold 80 boxes, the profit would also be calculated for 80 boxes. So revenue for 80 boxes at the rate of 12 rupees. 12 8s are 960, $960, right? Cost of sales. What's the formula for cost of sales we discussed? Opening stock.
As purchases minus
Yeah,
close.
it is nil. It is zero because nothing we have. Purchases. Purchases is what? How many boxes you purchased?
100.
Yes, 100 boxes. Into per box 12. Okay. Minus closing stock 20 into 12. Is it right? So it is 80 boxes into 12. 80 boxes into 12 into 10. Sorry. Our cost was 10, right? The selling price is 12, but cost price is 10. So I just forgot. Sorry. 10. 10. So 80 into 10. So that is 800. Am I right? 960 minus 800 is 160. That is your gross profit. Correct, Umaya? Just note it down.
Yes.
Yeah, please note it down in your book. We'll move forward. So now, okay, I'll open a new page, fresh page. Now, so revenue, cost of sales, already discussed. Gross profit, you'll be getting other incomes. Other incomes are all the types of incomes, either operating income or non-operating income, like operating income, see, revenue, operating income is nothing but revenue minus cost of sales, gross profit less administrative expenses. If you do, you get operating income. So fine, I will just write down other incomes here. Other income means dividend received, If you invest your money in any of these stocks, will you receive dividends or not from that? Yes. Interest received, profit on sale of asset, if any. Okay. Profit on sale of asset and yeah, any such kind of incomes will be another income. Then all the expenses you have to remove: administrative, sales and distribution, finance cost, you'll get PBT, profit before tax. You have to remove the income tax expense, you'll get profit for the year. Fine. Then goes the statement of financial position. You already know. You already have you have all non-current assets, property, plant and equipment. Then you have intangible assets like patents, trademarks, copyrights. Then in current assets, you have inventory, trade receivables. Okay. Other current assets, cash and cash equivalents. So all this total together will be total of current assets, total of assets, because non-current assets and current assets total together is total of assets. And then is it clear to you, Maya? Non-current assets and current assets total together is total of assets. Hello. And then it has all the equity and liabilities. Equity is your contribution, your capital in the business. Share capital, share premium. Premium is nothing but if the shares of the company are sold at premium, higher price. So that also is a part of equity. And then we have already discussed that premium account is used to, you know, issue bonus shares. Retained earnings, every year company's profit will be transferred to this account called retained earnings account. Then revaluation surplus, just we discussed. Then comes long-term borrowings, long-term loans or provisions, and then current liabilities, the obligations which you need to settle within 1 year of time. Trade payable, short-term borrowings, current tax payable, short-term provisions, etc. Then you have total of equity and liabilities. Once you can go through this format, and then we'll move forward. If you tell, I'll scroll down.
Okay, sir. You can continue. Like I'm already using my book.
Retained earnings. So note that according to IAS 1, a liability should be classified as current when it is due to be settled within 12 months of the year end. If it is due to be settled after that, it should be classified as non-current. Already we have discussed retained earnings. Now, what is retained earnings? It is important at this point to have a look at retained earnings. This is the most significant reserve and is variously described as, you can also describe it as revenue reserve, retained earnings, accumulated profits, undistributed profits, unappropriated profits. All 5 names. So there's an example here. Let's discuss. So these are profits earned by the company and not appropriated by dividends. That means these profits are the profits earned by the company. Okay, but not from the income, not from the dividends, whatever you have. It's not like something you have earned from your investment. You have earned this by your from your operations, right? And not and are not appropriated by dividends, taxation, or transferred to another reserve account. When we looked at sole trader financial statements, we simply referred to this as profit over the years. The profit of the sole trader accumulated and along with drawings form part of capital section of the statement of financial position. In the case of company, it earns profits and the owners take drawings. But in this case, we refer to the profit as retained earnings and the drawings as dividends. Okay. So dividends is drawings here. That means the money which is withdrawn from the company and is paid to the shareholders. Fine. Provided that a company is earning profits, this reserve generally increases from year to year because every year profit is transferred to retained earnings account. There's an example given. If a company makes a loss of $100,000 in 1 year, yet has unappropriated profits. That means what is unappropriated profits means what? See, what do you mean by this not appropriated? Company has earned profits, but the profit is after meeting all the obligation. What obligation? First, taxation, tax is paid. After paying tax, we get PAT. This is transferred to retained earnings. Now we will pay dividends out of it. Okay. And then we will transfer any amount we want to transfer to another reserve will transfer from this retained earnings account. So let's say there is a company which makes a loss of $100,000 in 1 year, yet has unappropriated profits from previous years totaling 250,000. It can, so this is the profit they have. So they can just bring it this year. This loss will be deducted from this profit and the leftover is 150,000. From that they can make the dividend payments. Okay. One reason for retaining some profit each year is that company can either pay dividends or company can reinvest that in the future. Okay. Or use this as a capital. Am I right? Hello. Yeah, because it is company's own capital. It acts like company's own capital and can be reinvested in the future. Okay. So let's go for the next question. So you should be very clear. Sorry.
Can you please explain again? Like for example, if a company makes loss of 1 lakh.
Yeah. I will explain. See, first of all, what is unappropriated profit? You should be understanding this. See, unappropriated profit is nothing but the profit which hasn't been allocated to something. Okay. So whatever the profit company makes in a year is a pure form of profit. Now, after that, some amount will be allocated or appropriated for dividends or for some other purpose. Fine. So you should understand that unappropriated profits is nothing but some profit from which some kind of allocation has not been done. Are you understanding? That means this is a profit of the company which it will keep with itself. If it wants to allocate some part of that profit or some part of that money, if it wants to use for a particular use, they can do that. If they have not, like if the company has a profit of $100,000 and from this they haven't allocated or haven't decided that some amount they will be using for some particular purpose. Okay, then till that time this will be called as unappropriated profit. But let's say if I have like decided that 20,000 will be going for dividend payments. Okay, then I have allocated this money for some particular purpose. So my unappropriated profit would be left over with me. How much? $80,000, right or wrong? Yes. Yeah, that's all. Now, let's say company has made a loss. So this year it has made a loss. But previous year they had a profit, unappropriated profit of 250. So that previous year profit is also with them, right? So now this loss is nullified from this profit and leftover amount is still $150,000. Correct or wrong?
Yes, sir.
So see, are you understanding?
Yes,
There is
I
a
am.
loss of 1 lakh this year. Previous year profit of 250 brought forward. Loss is nullified. The
Yes.
figure what is left over is 150. From this, can I pay dividends? I can appropriate or allocate some amount for dividend payments. Yes, I can do that.
Yes.
There is an illustration, Umaya. Let's go for this illustration and try to solve a question here. Okay. If I am not wrong, basically you should be doing this question. Generally, why? Because you have already done the question related to sole traders. Okay. So read this question. We will solve this. No problem.
Draw the statement of P&Ls and statement of financial position or AROCO for the year ending 30 September 2016. Revenue.
Read this, read this. I'll be scrolling down. When you say, I'll scroll down.
Revenue 12,000.
Yeah, see, the company, Arrow company, the statement of profit or loss and statement of financial position of for Arrow company for the year ended September 30, 2006 is given. Arrow company statement of profit or loss for the year ended is this. They have given
First they
revenue,
are
cost of
preparing PA and
gross profit and everything is given. Profit for the year also is given. This is the 2006 statement of profit or loss. This is the statement of financial position. Now, see, we know both the things what they are. The following information was accounted for when the financial statements were produced. During the year, the company made a rights issue on a 1-for-6 basis. What is 1-for-6? Every 6 shares, one share will be given as right issue. That means they will give one extra share to the existing shareholders. The criteria is the existing shareholder should be holding 6 shares, okay, with them. So for every 6 shares, one extra share is given. So the issue was fully subscribed and the rights issue price was $1.27. At this price, they gave the rights share. Prior to the rights issue, Arrow company had 30 lakhs 5 cents ordinary shares in issue. So they already had this much shares, which is issued in the market, and each share is of 50 cents. Property, plant and equipment was revalued by this much during the year. So this I told you where it should be shown, and a dividend of this much was paid during the year. Okay. So where will be this revaluation gain be coming? Umaya, this will be coming in other comprehensive income section. Am I right?
yes, sir.
Now let's solve this question. They have already solved. I have already explained you about the realized and unrealized nature gains and profits, which where would it would be coming. Okay. So company has presented it in two ways. One as one single statement pro forma one, two separate statements pro forma two. What is one single statement? Statement of profit or loss and other comprehensive income for the year ended 31st March 2007. This is what is given 6/7. Balance sheet is given two separate statements. Two separate statements. Statement of profit or loss. Revenue. Okay, so what they have done is one single statement. In one single statement, they have got profit for the year, other comprehensive income, total comprehensive income for the year. Two separate statements. What they have done, they have found out the profit for the year, and then again they have made statement of other comprehensive income separately. So either you can show them as one statement, or you can show it as a two statement. Are you understanding? In one statement, you are making the statement of profit or loss and OCI together. In separate statement, you are making SOPL separately and you are showing separately. Are you understanding? Yes. Yeah. So let's go ahead now. I'm making the statement. Okay. What is there to make the statement? Everything is clearly given. So we had all this revenue given already, cost of sales, gross profit, distribution cost, administrative expenses, finance cost, and profit for the year is given. You know one thing, gain on property revaluation is given, right? So can we take that gain on property revaluation? Yes. What is the gain on property revaluation? It was revalued by $600,000 during the year, right? So can I take this? Yes. So gain on property revaluation is here, Umaya. Are you following? Hello.
Yes, sir.
So this is already there in books. All this is very clearly given,
revenue, cost of sales, gross profit, distribution cost, all deducted, and you get profit for the year. And then you add the gain on property revaluation, you get the total comprehensive income for the year. Okay. Just have a look through this. Can you give me a second? I'll be back.
Okay,
Then
sir.
I'll finish this. Yeah. Just 2 minutes. Huh? Just 2 minutes. Actually, today is my daughter's birthday. So they are like kind of cutting the cake. So I'll be coming in 2 minutes. Fine.
Sir,
Yeah.
it's
No, 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 no,
already
no. That's
my.
okay.
I am exhausted.
No,
I
see,
am exhausted.
I'm ju- I'll just continue this for 10 minutes only, Umaya. 8 o'clock we'll stop.
Okay.
Don't worry. Give me 2 minutes of time.
I will wait.
Yeah, actually today is my daughter's birthday. I
Yes,
don't
yes.
see my students are also like my children. Okay. But my daughter is also my child.
No,
So
no,
all are
it's
my
not
child.
that I am
That's what.
feeling ki are you are going. No, I'm not feeling like that. I'm saying ki I am exhausted for now. So like
No,
we can
I
stop. But you
understand.
said now
See,
we will complete the solution and
yeah, I'll just come in 2 minutes,
yes, sir.
two to 5 minutes. Yeah,
Yes, sir.
I want see. I wanted to make this topic very interesting for you, so I'm putting all the efforts. Okay, yeah.
Yes, sir.
Give me 2 minutes of time.
Yeah, yeah,
Till
please
that time, you
continue to.
work out. Huh? Okay, okay. I'm coming.
Okay, sir.
Yeah, hello. Yeah, let's fix this. So have you seen this, Maya?
Yes, sir.
So now we will just close this. Tomorrow we'll discuss statement of changes in equity. Okay.
Okay, sir.
Yeah. Uh,
Hello.
we have started this. So
Hello.
uh, this, yeah. Hello.
Hello.
Hello. Hello.
Sir,
Maya, can you hear me?
yeah, it's not
Hello.
clear. It's not clear. Means if you are speaking
Yeah.
continuously, it's not
2 minutes.
clear.
2 minutes.
Hello.
Can you hear now? Hello.
Yes, sir.
Hello.
Yes, sir.
Yeah, okay. See, so there are two things, right? Was with one was with single format, with one was with this one. We did. There are two things, right? Uh, one is one only one statement is made whereby you show statement of profit or loss and as well as other comprehensive income. This is that. So you see this format, profit for the year on property revaluation, and this is only one on one single format. You can make this in two formats as well. So revenue, cost of sales, gross profit, distribution cost, administrative expenses, finance cost, everything was there in the format, right? From here, see, everything was there in the data.
Gain on property revaluation.
Yeah, the data is here. We have everything as it is. Okay. And then only one extra thing got added here, that is other
Gain on
comprehensive
property.
income
Yes.
revaluation. Yes, see, I'll show. So they are making it in a separate statement.
Oh,
They
yes.
had this, yeah,
I
profit for
understood.
the year and gain on property revaluation. That's it. Okay. So we will close this today here. Tomorrow we'll start from statement of changes in equity. Okay, Maya?
Okay, sir.
Yeah, and I'm sharing the detail of test which is there on Monday from for chapter 1 and 2 FA. Okay, I'm sharing with madam, and I thought of taking a long session as well. Today we have taken full class. We will see tomorrow. If not, I'm not going to academy. We'll try to take long session also. Okay, I'll try to finish it. Yeah, tomorrow is done. This chapter is finished tomorrow. That's not a. There is no second thought regarding this. Probably, if we have chance, we'll start with consolidation also tomorrow. Okay. Hello.
Hello. Yes, sir.
Hello. Hello.
Hello.
Okay, Maya. I will try
Yes,
to
sir.
take. We will try to take one more chapter as well. Okay.
Yes, sir.
Okay. 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 If I'm not going tomorrow, I'll inform you. Okay, Maya.
Okay, sir.